What's going on, everybody? Good evening to you, or good day if you're in Australia, maybe good morning. Hope you're having a great week. Welcome to the financial stream. Glad you're here. Thanks for joining. Let me move this camera just a little bit. There we go. What are we going to be talking about? Well, we have to talk about the banking world and what is going on with SVB, Silicon Valley Bank, some other domino effects in the banking industry, and of course what's happening to the stock market. We're going to do some peer-to-peer chit chat also today, and a couple of announcements too about upcoming stream guests that I'm super excited about. But if you could, you know what I'm going to ask you to do. Just hit that thumbs up for me. I appreciate it so much. You have no idea. Really glad you're here. Let's do the announcements real quick. I made a fancy little graphic. Oh, and by the way, you shouldn't have any issue with buffering now. I've run a hard internet line connection to my modem, so let me know if you're having any buffering issues. That should take care of it. My internet speed should be about double what it was running the Wi-Fi. So as promised, I think I got it fixed, so hopefully no more issues. But announcements. Livestream guests coming up. We've got 3 amazing guests starting on March the 23rd right here, same time. I did get a little displaced by the time change again. There's just a couple of times a year where it goes to 4 hours and I just get confused. I don't always check the times, but anyway, it'll be 7:30 p.m. UK time, March 23rd. We have Folk to Folk here. March 30th, we've got Rob from Plend, of course, one of the founders. And April 13th, Managing Director of Capital Stackers, Steve Robson, is going to be live here. He saw the stream where we were talking about capital stackers last week, and he reached out to me and he said, I want to give you some information about capital stackers and show you what we do here, because it's some of the things you probably don't know. And he was right, I didn't. Capital stackers has never really been on my radar, so I'll talk a little bit about that also on the stream, about what I discovered about capital stackers that I didn't know last week when I started talking about them. But yeah, they're going to be here. Steve will be here on April the 13th next month, so Thursday evening. So please put those in your calendars. It makes a big difference to have you all here participating, and you get to learn from the people themselves, the founders who have put these businesses together, who are offering these services, lending services and investing services. Not quite yet with Plend, but we'll get some updates on that. But certainly Folk to Folk being the UK's largest retail peer-to-peer lender at the moment. And then Capital Stackers, which is definitely more of a very interesting, I think, product that they offer, and I'll tell you all about that, why. So hope you can join us live, and if you can't, you can watch it on catch up. But quick hello to everybody in the stream jam. Robert's here in a balmy Toronto, Ontario, Canada. Dave Dawson is here. Alan Toombs, Colin in the Peak District. Peter Vince is always in Leatherhead. Stevie from Macclesfield. Debbie at the Mixed Media Arts in the Grand Cayman. Mike Powell's here. Aki Chap is here, of course, in Accrington. Paul Bagworth and Kenilworth. Mike Powell. Started bad, but okay now. So what? The stream started out bad. Never had any buffering until today. It's so frustrating. Anyway, I hope it's okay now. Annabelle, welcome. Hi. I know you're in Spain. So welcome to everybody watching. And welcome to you watching in the future. Let's get right into some peer-to-peer lending news to begin with. Let's get that knocked out of the way. Not much news this week, really quiet, but a couple of things I think are noteworthy. Crowd Property has launched the Seeders campaign, and they've raised a little bit over £316,000 in 3 days of a £400,000 target. I have actually had quite a few emails about this. Again, people asking, I want to be an investor in Crowd Property. Is this a good way to do it? I always tell people, do your due diligence. You can certainly make money buying these types of shares on Seeders. If we look at Seeders' campaign, this is the one that is running right now. You see they've raised £316,153 from 291 investors at a share price of £28.13, which puts a pre-money valuation on that company at £41.9 million. Again, yes, you can make money. It is highly speculative. Anything on Seeders is highly speculative. But if we look back to their last fundraising round, you can see that the share price has gone up 269.2%. So you can see started here at £5.90 on December 2019. 2017, went up to £13, 2019 in April, and then £21 valuation 1st of September 2021. Is it a guarantee that you're going to make money on these Crowd Property shares? Absolutely not. There are many different factors: price, demand, supply, liquidity. But it's certainly a possibility. So if you're into that type of thing, go check it out. They're doing fundraising, obviously, for their business to collect money to grow. And I think they collected about close to 1.9 million back in 2021, the last time they did it. So interesting proposition. Let's take a look at the loan pad. This is the March update that they sent out. And it says, LoanPad is pleased to report that all loans are performing with no material issues. As you all know, every loan we do is a maximum of 50% loan to value. We do not consider any volatility in the markets, talk about stock market, and or house prices to represent a material risk to our investors. The current aggregate loan to value across the portfolio is just 42%, with 175 loans within the portfolio. They now have 12 lending partners, including the recent addition of 2 new partners. I do not have much information on those, but I will be finding out from Louis over there who those lending partners are and exactly what they're up to. They are keeping an eye on the interest rates, of course, as I just got a new interest rate increase email from Ford Money that it is now over 3%. So obviously, LoanPad has to keep an eye on those interest rates to remain competitive. Right now, they are at 4.2% on the Classic, 5.2% on the Premium, and that is going up on the 1st of May to 4.4%, and then 5.4% respectively. It's definitely getting more attractive at 4.4%. You're still taking some risk, but compared to what you can get in the bank, it's a little bit of an extra bump, and certainly I would consider, again, not financial advice, but LoanPad to be in that lower risk tier of peer-to-peer lending, and they've been operating well. They've been doing what they promised for a while now, so to see those interest rates increase is absolutely nice to see. And again, I use the premium account, the 60-day notice account, which will be 5.2% in April, 5.4% in May. And I think that's a pretty attractive rate for what LoanPad offers. Remember that you have until the 5th of April 2023 if you want to invest ISA funds. You can do that directly via LoanPad or through another ISA manager. Also mentions in here that LoanPad does not have any accounts at Silicon Valley Bank or Silicon Valley Bank UK, so no exposure there. So a good update, I would say, from LoanPad for March. In turbulent times, peer-to-peer has a role to play in a balanced portfolio. As you know, unless you've been living under a rock, we've had some really turbulent times over the last few days with what's going on in Silicon Valley Bank. And, I've talked about the banking sector before, about the lack of liquidity and fast liquidity that exists within the banking system because of the loose guidelines that exist in certain countries to regulate banking as far as how much money they have to keep on reserve, which we'll talk about that also. But this article is making a very good point that peer-to-peer should, I don't know that it's a given for everybody. It depends what your risk appetite is, but personally I believe that as part of a diverse portfolio, peer-to-peer lending definitely has its place, and we've now seen these weaknesses in the banking system that I've been talking about for a while. If you were to take a certain percentage of your liquid net worth, put it into peer-to-peer lending as that diversification play, I don't think that's a bad thing. I really don't. I've said this for a long time. Would I put 50% of my net worth into it? Probably not. But to take a managed risk amount along with stocks and shares, maybe some savings account, liquid cash, real estate if you can afford it, which most people, that's a pretty expensive endeavor at the moment. Maybe some cryptocurrency, you bundle it all together, maybe some gold, which we're seeing a lot of people running to gold right now because of this exact issue that now has shown a weakness in the banking sector. Yes, I think peer-to-peer definitely has a place in a diversified portfolio. How much are you going to make? Probably, if you invest correctly, around 6 to 8%. You could probably rely on if you make some smart decision choices about having some low risk, medium risk, high risk. Some people are going to get more. They're going to take more risk and go for the riskiest side of peer-to-peer lending. Maybe they get higher interest rates. But I think a well-diversified portfolio, probably 6 to 8%. This is an important article that came out. New mortgage offers down 33% in the wake of the mini budget. The latest Bank of England figures, this was the fourth quarter of 2022, show that new mortgage commitments came in at £58.4 billion in the last 3 months of the year, which is a 33.5% quarter-on-quarter drop and a 24.5% year-on-year decline. The central bank also showed the value of mortgages advances fell by $4.3 billion in the fourth quarter. Why is this important? Well, because it really affects peer-to-peer lending, especially a lot of companies now involved in the property development side. And while it is an important article, how much it's going to affect peer-to-peer lending in general remains to be seen, because we still have a housing shortage in the UK, especially that lower tier cost of houses. I'm not sure that this news article, I don't know how much it's going to affect. Now, there are two ways to look at it. You could say, well, there's not enough houses for sale, so demand should stay strong. This article, however, is saying, well, 33% down because people in that lower price bracket are not going to be able to afford interest rates where they are right now. And they're probably going to get higher, which could mean entry-level housing really does slow down because of that lack of affordability. Number one, house prices are high. You couple that with high interest rates, now you have a bit of a problem. In the medium to higher end houses where people have higher incomes, maybe this is not so much of an issue, but it certainly could affect peer-to-peer lending. I know a lot of peer-to-peer bosses are really keeping an eye on the housing market, and especially interest rates. And I think, again, in about 6 days' time, we're going to get that notification that in the US, interest rates are going to go up, which will trickle down to the UK interest rates also going up through the Bank of England, and then also mortgage offers slowing down as mortgage rates go up too. We're seeing it happen here in the US. Housing prices are really starting to level off. In fact, if you go into a real estate website and search for homes, you're going to see a lot of the down arrows with the price reductions. I've seen it on nearly every property that gets released here in the US. All the prices are coming down. So an interesting article, and certainly an interesting thing to really keep an eye on, although how much it's going to affect peer-to-peer lending, not entirely sure about that, but I think in another quarter we're going to really find out. Now, I mentioned that I had spoken to Steve from Capital Stackers. Let me take a drink, sorry. Via email, and we got in a really interesting conference call a couple of days ago. He wanted me to really learn more about Capital Stackers and what they're doing in the background. And I have to tell you, it's probably one of the most impressive, at least transparent conversations that I've had with somebody from a peer-to-peer lending company, and the fact that he really divulged the behind the scenes of how Capital Stackers worked and works right now. Again, not very familiar with the company. It's just never been on my radar at all. But he, encouraged me to open up an account, which I did. And I started digging around. First look, the back end, nothing really special to it. It just kind of looks like a very basic peer-to-peer lending platform back end. It's kind of clean. I like it. It's not confusing. I find some of the peer-to-peer lending UIs, the user interface is confusing. But I started digging around, and Steve was showing me the amount of due diligence that they do on every single one of the loans that they offer. Now, Capital Stackers in most cases is being fed loans from banks, which is very unusual, right? The two really don't work together often because peer-to-peer lending was really designed to detach from the banking system. But Steve, he sees it in a bit of a different light. He's seen an opportunity there to where junior lending, which is, you could call it second position lending, has a real place in the marketplace to work alongside banks. So if a bank is approached by a developer and the bank says, you know what, we'll lend you 50%. A lot of times these development loans cannot go through because that developer doesn't have the 50% cash to put into the deal to make it happen. Maybe they have 10, maybe they have 15 or 20, but it's highly unusual to have 50. So this is where Capital Stackers is able to step in and really make development deals happen that probably wouldn't have happened because of the banks. So Capital Stackers is getting fed these loans from a few different banks, and these banks have done incredible amounts of due diligence. But not only do the banks do their due diligence, Capital Stackers also runs their own due diligence too. And Steve showed me a spreadsheet. By the way, Steve is the founder. He is, let's see if I can find him. Hold on. Show you. He has a lot of experience in lending, which is pretty cool. To hear him talk about his experience how he's learned to really look at deals and make sure that the deals are correct for the platform. So you can see him here. He's worked in property finance for 35 years. And he's really a numbers guy. He's also the founder of PyFrame, a property risk analysis software house. He's a numbers guy. He showed me this spreadsheet that they run through every single deal into. And it's probably one of the most intricate spreadsheets that I've ever seen. And for anybody that appreciates that type of in-depth analysis, we really appreciate that spreadsheet. I mean, it had probably 10 different tabs of risk analysis, cash flow, debt analysis, good case scenario, medium case scenario, worst case scenario, and all the numbers were in there, and it had risk scores. It was pretty amazing. It certainly gave me a lot of confidence to talk at least about capital stackers and how they work their deals, because on first appearance, the amount of interest that they promise to pay is quite high. And a lot of the times we've seen cases where when a peer-to-peer lending company is offering high interest, it's, is it too good to be true, right? You've got high returns here of 30.6%, which is unusually high. I'd say the 15.5% average return is probably more likely. And then you've got the lowest return, 6.88%, where in those cases, Capital Stack is actually a first position lender on those deals. The 15.15% is probably what you're going to see. But what I most was impressed by with Steve is his transparency. He showed me how much of his own finances he was investing into Capital Stacker's loans. And that was pretty much 100% of his net worth. He's done so much analysis and so much due diligence on all of these loans, and along with the bank, that he truly 100% believes that there is no better investment for him to be in than these Capital Stacker loans. They've been going for about, I think, 13 years. I think they started in 2010. But when he comes on the stream, he's going to explain that. But if you go to the Capital Stackers portfolio statistics page, it's going to shows you right here. This is this line down here, which I don't really know what this meant. I'm going to show it to you. Connected investment. 24.9%. So out of every loan the Capital Stackers offers, 24.9% of the loan is taken up by Capital Stackers, like founders, family members, close people connected with the business. So they really believe in these loans, and they really have a lot of trust in what they're doing. I find that really, really impressive. And then if you go into their back end, their website, and this is going to be good for people that really like to do a lot of due diligence, because it does have kind of a high entry point of £2,500 alone, which for a lot of people is high, and that's, could be considered risky. But they have so much information here on the loans itself. Everything you could possibly want to know. Of course, I pulled that up and it said nothing. Hang on one second. Everything you could want to know. It shows you this interesting thing called a capital stack, which shows you the senior debt, the profit, development, cash equity. It shows you exactly how much spread is being taken. So there's complete transparency. And if you go to the data room here, you can pretty much pull up all of the legals, the ongoing monitoring. I believe the financials are in there. Here is one that I pulled up, and it has these little risk bars. These are in-depth document. This is a 51-page document here, just on the monitoring report itself. So for anybody that really likes to learn about loans. You can see photos, updates. It's very, very in-depth and very intricate. I had to say I was really super impressed. And I'm not paid to say this. I don't invest through capital stackers myself. But I was so impressed by the amount of in-depth financial work and modeling that had gone into every single one of these deals that it did really make me think, wow, if I had extra liquid cash, this would probably be a website and a business that I would be very, very seriously looking at, just because the amount of information they've been pulling together for you, for anybody that cares to, take a look at it. So it shows you the expected coupon rates, the IRR, investment returns for each of the different layers or the different risk amounts. So if you take higher risk on a layer, they call it layers. If you take a higher risk layer, you get more compensation. You could take a lower risk layer and get less compensation. But even look at this 55.2% loan to value, 14% coupon. I mean, it's very high. And there's just a ton of information. So, I would highly recommend that you tune in April. Come listen to what Steve has to say and learn really about capital stackers, because we're always looking for places to come, and we want to be as safe as possible, right? There is no true safety in financial investing. There can't be, because if you want to get returns, you have to take risks. But transparency, I think, is everything, and capital stackers, I think, is one of the possibly most transparent financial models that I've ever seen. At least it's been presented to me. I'm sure there's other peer-to-peer lending companies that do a lot of this type of analyzing on the back end, but they don't always show it to me in full transparency. So Steve, his goal has always been to be 100% transparent with investors and to supply all of the information, including profit levels, how much the developer is making, how much capital stackers is making off a deal, how much you as a investor are making. You can see everything. And I think that's very, very, very refreshing. And it's something that I wish every peer-to-peer lending company offered that type of transparency, because it is so important. Yeah, come back on April 13th and learn more about capital stackers, because I think you're going to really enjoy that information that Steve's going to present. What else? Interest rates. They're going to go up. They're going to go up this month. I promise you that. I'm almost sure. I'm sure it's just going to, I think it'll be a 0.25% or 0.5%. But Ford Money sent out an email the last couple of days. You can get 3.1% now on a easy access account. Fixed. I don't know. I tend not to do fixed investing. What can you get on fixed? Let's see. You're going to open. Come on, Money Supermarket. Doesn't seem to want to work. Hang on. Unusual network requests. So look, you can get 5-year 4.5%. Not really worth it, I don't think. 1 year 4.3%. So obviously nobody's going to take 5 years. 4 point, only a little bit more. 2 years, not really worth it. 1 year, I don't think it's really worth it. But, you can get an extra 1% for a 1 year fixed. But those rates are coming up. Those rates coming at the banks. Now let's talk about SVB, Silicon Valley Bank. What happened? We have to talk about it because I think it's something that's been brewing for a while. I've talked about it for a while. About this just lack of reserve amounts that, countries and Federal Reserves require banking systems to have to pay people back. You can see here there's a list of some of the countries. See, the UK right now, I think it's 2%. Reserves don't technically apply in the UK, but I think legally they're supposed to have about 2% on reserve, which is really nothing. But we have countries like Australia and the US. You can see Australia has no reserve ratios in place, and then the US also no. Because the Federal Reserve in the US reduced the reserve requirements to zero, effective on the 26th of March 2020. You can see their news release here. On bank and liquidity buffers, this was on the Federal Reserve's website. I hate that little pop-up. I don't know why it's annoying me though. So yeah, this was in 2020 when they said that now the reserve requirements were effectively coming down to zero. So that's the reduced reserve requirement ratios to zero. And the banks are just basically leveraged up to their eyeballs. The reason why government and Federal Reserves do this is because they want to encourage lending. So they want that money, instead of being sat in the bank's hands, to be lent out to stimulate the economy, right? Problem with that is when people get scared, we see things topple, like, happened in Iceland, happened in Cyprus, now has happened in the US. Is it going to happen in the UK? We don't know. But Silicon Valley Bank was a big problem because they were essentially had lent out a lot of money, and they had bought a lot of government bonds, and which on the surface seems like a very safe thing to do, right? If a bank takes the majority of the money and they're lending it out to businesses, not so safe, especially Silicon Valley startups. They're taking a lot of their customer deposits and they're buying government bonds. The problem with that is, bonds, they go up and down in value, right? A lot of people don't really understand how this works, but you can see it in the Vanguard UK Government Bond Index Tracker Fund, right? This is a good example of how bonds can decrease and increase in value. So right now we have a price of £137 on this bond fund. The 52-week low was £119. The 52-week high was £168. That's a big difference. So if you buy a government bond that's, say, 5 years, right, in duration, and it pays 2%, and the interest rates go up, well, that bond becomes worth less money. Because now if the interest rates are 4%, you have a bond that only pays 2%. When you come to sell that bond, you can't get as much money because the new bond issuances are paying twice the amount of interest. And this is what has happened to a lot of the treasuries. So you can see here on this this index tracker fund that today has a value of £130.16, was once valued at £168. So that's a big difference. And even if you look at the historical prices of, if we go back, say, to 2020, to just 3 years ago, let's start at 2020. Although you can go all the way back to 2009 if you want. But if we just scroll through these prices, you're going to see how it's dropped. Right here we're at 155 in the 15th of August 2022. And I believe it goes as high as 189. So you can see here up to 187, 188, 189. This is just 2 years ago, less than 2 years ago. So pretty big drops from we're talking about, this is a bond fund, something that's supposed to be relatively stable, right? Bonds and treasuries. £137 now, down from 188. So this is what happened to Silicon Valley Bank. They had all this money invested in these bonds that people started coming to the bank and saying, we don't trust the bank, we want to get our money out. So, which is called a run on the banks. And then the bank doesn't have any reserves really, because they're not required to. So essentially the bank topples, because they then have to go ahead and sell government bonds or whatever treasuries they hold to get liquidity so they could try to repay back people, and they have to sell those bonds at a loss. And there was billions and billions of dollars which were lost during that transaction. It's an interesting New York Times article which kind of shows the timeline of how these events happened, and it happened very quickly, right? Silicon Valley Bank concerned investors when it said it needed to shore up its balance sheet and raise $2 billion in capital. It was forced to sell a bond portfolio at a $1.8 billion loss. In a letter to customers, Greg Becker, the CEO, chief executive of Silicon Valley Bank, said the bank enjoyed the financial position to weather sustained market pressures, but noted that customer deposits come in lower than forecast in February. And then it goes on to talk about the day before disaster struck, that the bank's stock plummeted 60%. And then the bank failed on March 10th. So this was really just within 24 hours. So March 10th, there was a run on the deposits. It was the 16th largest bank, 40-year-old bank in the U.S., and the U.S. government took over $175 billion in customer deposits. This is a very, very big wake-up call to people who think that banks are safe. And again, this lack of reserve implementation and people saying, well, my money is insured by the government, right? Same in the UK, we have, what is it, £85,000 coverage on a savings account. In the US, it's $250,000. But certain things happen when, if you have your money in a bank and that bank gets frozen, now you don't have access to your funds. Well, yes, it's insured, but you're not going to get access to those funds necessarily quickly. Now, the Fed came in, or the FDIC, and took control of this bank very, very fast because they knew what was going on, but that doesn't always happen. They're saying here that this bank failure, which also this bank has Silicon Valley has UK presence, that it shouldn't affect the UK banking system. I would say that this is a really big problem because we all know what's going on in the economy. I mean, it's in plain sight, right? This banking disaster alone has caused some pretty nasty stock market falls. Of course, me being the genius being invested into a banking stock, because 2 months ago there wasn't really any talk of there being any necessarily. I mean, there's been some murmurs of Credit Suisse having some issues, but I bought Deutsche Bank shares in the Trading 212 portfolio. So you see what a effect this last stock market run has had on this account value, which was close to 19,500 just a few months ago, is now £5,000 lower. You see the Deutsche Bank stocks here in the red. I thought about cutting and running and decided not to, because I don't know that this is going to have a big domino effect on the banking industry yet. I tend to, when I make fast decisions about dumping certain stocks, it doesn't work out very well, so I held on for a little bit just to see what's going to happen. But this is a big problem. This is a big problem because banking issues have such a domino effect on all different facets of finance, stock markets, economies. When people stop trusting the banks, which they probably shouldn't have trusted them always in the beginning anyways, because, I've said this lack of liquidity is a very, very big problem. If everybody runs to get their money out of a bank at once, or even just probably 10% of the people, none of the banks are going to really be able to make that happen quickly. They do have liquidity, but they have very slow liquidity. They don't have enough cash on hand to pay you back. So I think it's important to pay attention to this being actually a wake-up call. We have seen bank failures before in 2008 and 9. We saw the collapse in the UK of Bradford and Bingley. HSBC stepped in and rescued Silicon Valley Bank's UK arm, which was not a small bank. They took on about £5.5 billion of loans and 6.7 billion pounds of deposits. So this is not a crypto bank. This is a real bank, and potentially this could happen to other banks. There was a news story today. Let's see if I have it. There was another bank that was on the news, and I think it's called Republic Bank, that may be also in trouble. You had Signature Bank, which is based around cryptocurrency, that fell into trouble in the last few days. And of course, what's happening now is people are running to gold. So when the stock market gets shaky, where do they go? Safe havens. Maybe cash in the bank is not a safe haven anymore. People have gone to gold. We got a $1,919 price on gold. You see how this is kind of taken off from October of 2022. We had this fallback here on the gold price, and then this is when everything started to hit the fan with the banking system. Also saw Bitcoin jump up quite a lot the last 7 days. Seen it go from 20,300 all the way up to spiking up here at 26,000. Very volatile. Back down a hair under 25,000, of course, because people starting to understand that, hey, while Bitcoin's volatile, it's not controlled by an institution. It's not controlled by the Bank of England or the Federal Reserve in the US. It's controlled just price, supply, and demand. And there's a lot of people that like the idea of a free-flowing investment vehicle that is not controlled by an entity. So what's going to happen in the future with banking? It's really hard to say. But it certainly has really shown the fragility of how banks are set up and how they possibly could fail. And remember, if banks fail and governments step in, it's you, the taxpayer, that has to pay for the bailout, like you did in 2008 and 9, like we did, like I did. We paid for that bailout. And it's important to really just kind of be aware of what the heck is going on, because I believe that right now this is, again, a house built on sand, what's going on in our financial system. And these cracks are starting to come. Could this be the start of the big fallout that certainly a lot of people have been waiting for, that big stock market correction? That dump. Is this the first sign? Are we seeing this banking weakness combined with high interest rates, a slowing housing market, expensive mortgages, higher inflation? Even though we did see the CPI in the US go down to, I think, 6%, it's still 6%. It's supposed to be 2%. So this is a concoction of this bomb that's ready to go off in the financial world. And this SVB banking situation really, really scared a lot of people. And the stock market did not like it at all. People ran to gold. And, maybe peer-to-peer lending is one of these safer havens. I don't know. Nobody knows. We're not psychics, but it could be one of these safer havens that detaches you from the bank in most cases. Not with capital stackers, because they're doing deals with banks, but we've seen bank failures happen before, and I would not be surprised to see more happening in the future. So keep your eyes on what's going on, because this can have a really, really detrimental effect on stock markets, other facets of the economy. It's a big disaster. And there's a lot of questionable activities. I've read stories about people in the bank selling shares the day before the collapse happened, So it's not just peer-to-peer that is suffering with people taking bad actions, doing things that are not right. Kind of makes me feel a little bit better about peer-to-peer lending, to be honest, because we've kind of been the black sheep of finance for a while, along with cryptocurrency. And when I had a chat with Steve from Capital Stackers, he said the same thing. He goes, we seem to get grouped in by the FCA with cryptocurrency, and we're the red-headed stepchild of the finance world. I think that's a very valid point. It's very interesting. Anyway, that's what I got for you today. Constant buffering. Okay. I hope the buffering sorted itself out. I don't trust the banks anymore anyways. I've never liked the banks, but what are you going to do? Lawrence, I'm on Capital Stacker's website. I cannot find all of the info that you're discussing. Okay, let me show you how to find it, if you're interested. Where are we? Capital Stacker. First of all, you're going to have to log in to find this information. You can find all of this info if you go to opportunities. And then you want to look at the deals. You just click on that view deal button. This is also a completed deal, so maybe that's why you can't find it. But here, all of those informations. And when they have new deals, they are going to get put up in the opportunities section. Because you have to be able to bid, and you have to get your bank account registered. I haven't done that yet. They also have a secondary market, by the way. But if you want to find out about their statistics and whatnot, you can just go to their website. Let's go Capital Stackers. Just go to their website and then scroll down here to the bottom. Right down here. Portfolio statistics is one, and deal portfolio 2 is another page that's worth looking at. This shows you a lot of information about all the different deals. Shows you down here the stack. This is the profit margin expected, the equity amount, the Capital Stackers debt amount, and then the senior debt amount. So I like the way those little blocks of color show you exactly what's going on. You could click on this full detail here. It's going to give you some expected return amounts for the different layers of risk. You can see here a return of 9.72% on a look at this 29.2% loan to value will get you 7.55% projected annual returns. So yeah, I hope that helps. Have a dig around. good joke about Silicon Valley. Yeah, I think banks can fail, absolutely, and we're gonna see. We're gonna see what happens. It's gonna be interesting. Anyway, I think I'm gonna get out of here. It doesn't look like you have any questions, so we'll see you next Thursday. Again, come back March 23rd, Folk to Folk. March 30th, planned. April 13th, Capital Stackers. Please subscribe to the channel if you're not already subscribed. Consider becoming a Patreon member. There is a link in the description if you're interested in doing that. I appreciate every single one of you for being here today, and I'll look forward to being here again with you. Take care. You have a wonderful weekend, and I'll speak to you next week. Take care. Bye.